The ongoing increase in tariffs on Chinese goods by the United States has caused panic in the market. Investors are selling off Chinese assets, which is leading to an outflow of capital and a sharp depreciation of the currency. On the night of April 8th, the offshore Chinese yuan hit a new low, dropping from 7.3 to 7.4 against the US dollar, breaking the previous 2022 low and hitting its lowest point since 2007. This is a historic moment. Some Chinese financial analysts believe the depreciation of the yuan benefits export-oriented companies, as it reduces the damage from the trade war and supports domestic consumption. Over the past 2 years, the yuan has mostly stayed between 6.6 and 7.4. The recent drop below 7.4 seems to be part of a strategy by the People's Bank of China. It's a tactical devaluation to protect exports while cautiously testing the US's limits. It's worth mentioning that this is the first time in recent years that the yuan's central parity has broken the 7.2 mark. Even with significant pressure to devalue, the central parity had stayed above 7.2 over the past year. Investors had considered 7.2 a soft red line that Beijing was determined to defend. Industry insiders believe the breaking of this level is mainly due to the 50% tariff increase that President Trump announced on April 8th. That evening, Trump attended a National Republican Party event, where he said,
"They got every trick in the book. I'll tell you, they are great. You got to hand it to them. You got to hand it to them. They're manipulating their currency today as an offset against the tariffs. You're not supposed to do that. The game isn't supposed to be played that way."
In a speech lasting over an hour, Trump highlighted China's trade aggression, including record tariffs, non-tariff barriers, illegal subsidies to businesses, and large-scale currency manipulation, all of which he had aimed to address during his first term. In fact, after Trump's first round of tariffs, the Chinese government took similar measures in 2018 and 2019. Beijing devalued the yuan against the dollar by more than 10% to counteract the tariffs. At the same time, Chinese exporters shifted production to countries like Vietnam and Cambodia, using third countries to reroute goods to the U.S. This shows that devaluing the yuan is a tried and tested method for China to deal with tariffs. A weaker yuan makes China's exports cheaper for foreign buyers, helping mitigate the damage done to China's competitiveness by the tariffs. During his second term, Trump increased the tariff rates on all Chinese goods, eventually reaching a total of 104%. Beijing has now vowed to fight to the end, hinting at possible further retaliatory actions. On the evening of April 9th, the Chinese State Council issued an announcement imposing an additional 50% to 84% tariffs on all U.S. imports, effective the next day. The announcement also included sanctions on 6 U.S. companies, adding them to the unreliable entity list, and placing 12 U.S. entities under export control. With this, the trade war between the U.S. and China has entered a more intense phase. China's retaliatory tariffs may seem strong, but due to the country's reliance on exports and the limited impact of the tariffs, they appear more symbolic than effective. Shortly after Beijing's announcement of the 84% retaliatory tariff, U.S. Treasury Secretary Scott Bessent was interviewed by Fox Business. He called China's decision a failed proposition for the Chinese government. He also said,
"Yeah, I think it's unfortunate that the Chinese actually don't want to come and negotiate because they are the worst offenders in the international trading system. They have the most imbalanced economy in the history of the modern world, and I can tell you that this escalation is a loser for them."
Later, the Treasury Secretary warned Beijing not to try and evade conflict by devaluing the yuan. He further pointed out that if Beijing starts devaluing its currency, it will prompt other countries around the world to constantly raise tariffs on China to offset the effects of devaluation. If the tariff war continues to escalate, Sino-U.S. trade relations will undoubtedly reach a historic low, potentially even leading to a complete decoupling. Unless China makes significant and fundamental concessions, such as appreciating the yuan and bringing manufacturing back to the U.S. will not back down in this war with China. Nomura Securities chief China economist Lu Ting analyzed that the U.S. and China are locked in an unprecedented and costly game, with both sides seemingly unwilling to back down. Lu Ting believes the yuan will certainly face pressure. However, unlike in 2018 and 2019, considering the crisis in the real estate market, Nomura believes that the People's Bank of China will avoid large-scale depreciation of the yuan to maintain stability in domestic finance and the real estate market. Moreover, as early as February 6 of this year, U.S. Treasury Secretary Scott Bessent hinted that China might be on the list of countries particularly concerned about currency manipulation. In an interview with Bloomberg, Bessent said that China is the most unbalanced economy in world history, and now they're in a severe recession. They're experiencing deflation and trying to use exports to get out of the predicament. Bessent also discussed the strong dollar policy, saying that the administration wants the dollar to strengthen, but they also don't want to see other countries manipulating trade by devaluing their own currencies. The drastic fluctuations in exchange rates makes one wonder, what does the future hold for the yuan? More and more analysts are predicting that the yuan will continue to weaken in the near term, though opinions vary on the extent of the devaluation. Professor Chen Zhiwu, a finance professor at the University of Hong Kong Business School, told Associated Press, if the additional 104% tariffs really continue for the next 6 months or longer, it will essentially lead to a true decoupling of the US and Chinese economies. He warned that China's economy would face long-term and very severe damage, leading to mass unemployment, business closures, and potentially social unrest. Chen Zhiwu added that China might take retaliatory measures by devaluing the yuan to offset the damage caused by the tariffs. This would further restrict exports of products essential for American households. Chen Zhiwu told the Associated Press, I think China may have already implemented some measures, including adjusting the yuan exchange rate, devaluing it by 15%, 20%, or more. This would essentially offset a large portion of the losses caused by high tariffs. Arup Chatterjee, managing director of macro strategy and emerging markets at Wells Fargo, said, we believe the pace of yuan depreciation will accelerate from now on, with Chinese authorities signaling greater exchange rate flexibility through the central parity rate. He said this will be a managed, continuous devaluation, which could cause the offshore yuan to drop $1 to 7.5 yuan or even lower. However, a report from Nanhua Futures states, we expect the USD-CNY spot exchange rate to likely stay above 7 in the second quarter of 2025, but we do not foresee any significant momentum for it to break above 7.5. It is important to note that in building a significant exchange rate system, caution should be taken to prevent the risk of rapid appreciation or depreciation under both tightening and loosening measures. In an interview, senior foreign exchange strategist from UOB, Xie Qi-xiong, analyzed that as the tariff between China and the U.S. intensifies, yuan volatility will further increase. He predicts that the yuan will fall to 7.55 against the U.S. dollars in the second quarter of this year, dropping to a low of 7.8 in the third quarter, before recovering to 7.6 in the fourth quarter. Recently, Barclays Bank stated that under extreme conditions, including potential industry tariffs, they believe the onshore yuan could depreciate by about 21% against the dollar. According to Barclays analysis, the exchange rate could not only break the 8.0 level, but may even surpass 8.5. However, some market participants predict that the yuan's depreciation won't be too severe, as such a devaluation could accelerate capital outflows and undermine investor confidence in China's capital markets. In response, economist Davy J. Huang, based in the United States, commented in an interview that both Barclays and the U.S. have significant investments in China, including Chinese businesses and U.S.-owned shares in Chinese firms. Through this kind of report, Barclays may be attempting to guide clients to divest from yuan assets and positions. He believes that while this analysis could serve as a market risk warning, a 21% devaluation of the yuan is unlikely to actually happen. If it did, the U.S. dollar-Chinese yuan exchange rate would rise to 9.8 or even close to 10. Huang stated that unless war breaks out in the Taiwan Strait, such an extreme devaluation scenario is highly unlikely. The pricing of the yuan is subject to significant administrative intervention, making it difficult to accurately calculate through market-based methods. He said that in the context of Sino-US trade and technological decoupling, if the yuan continues to depreciate, China may be labeled by the U.S. as a currency manipulator, which could lead to a new round of punitive tariffs or other sanctions, further worsening China's already strained economy. Huang believes that if the yuan breaks 8 against the dollar, it could trigger a global loss of confidence in the Chinese government's control over the country's financial system. A sharp depreciation of the yuan would lead to capital flight, with domestic funds pouring into gold and other safe haven assets, further intensifying capital outflows and pushing the Chinese economy to the brink of collapse. In addition, export costs could rise significantly. Apart from essentials like daily necessities, chips, and oil, China also heavily relies on imports for food. The the Chinese government would need to use a large amount of US dollars to procure these key commodities. During Trump's first term, China was labeled a currency manipulator. The then U.S. Treasury Secretary Steven Mnuchin immediately issued a statement declaring that the Chinese government was manipulating the yuan's exchange rate. This marked the first time in 25 years that the U.S. had designated China as a currency manipulator. At the same time, the U.S. Congress issued a statement claiming that China had long used large-scale, long-term interventions in the foreign exchange market to promote the depreciation of the yuan, aiming to gain an unfair competitive advantage in international trade. These actions directly led to Trump's trade war with China, which began as early as March 2018. In the first phase of the trade confrontation, on July 6, 2018, both countries imposed tariffs on nearly $34 billion worth of each other's goods. In the current situation, Trump is likely to resurrect the strategy as a means to target the Chinese financial system. Possible measures could include accusing China again of currency manipulation, creating legal and public opinion grounds for sanctions, restricting Chinese financial institutions' access to the U.S. dollar clearing system, such as SWIFT, CHIPS, and other key channels, blocking the flow of Chinese capital into the U.S. by strengthening the review of Chinese mergers and acquisitions, dollar-denominated bond issuances, and cross-border payments, and encouraging the decoupling of manufacturing and capital from China, replacing Chinese supply chains with those of countries like India and Mexico. The greatest threat of this strategy lies not in the exchange rate itself, but in the capital flow and financial stability behind it. If the pressure on the yuan's depreciation becomes uncontrollable, capital flight could trigger systemic risks within the Chinese government. In other words, currency devaluation comes with a cost. It could increase investor bets against China's economy, worsen capital outflows, anger the U.S., and darken the prospects for trade negotiations. In 2015, the yuan's depreciation led to capital outflows, destabilizing China's economy. Recent data shows that in the past 3 months, foreign capital has left China at a pace of nearly $50 billion, which seems to have a snowball effect, with the yuan's depreciation accelerating due to emotional sentiment. However, this capital outflow could become difficult to control, forming a feedback loop. As more and more investors rush to cash out of China, the downward pressure on the currency will lead to even more sell-offs. When investors do this, they exchange yuan for US dollars, yen, or euros in the financial market, effectively selling the yuan and buying other currencies, which weakens the yuan further. Especially with a sharp depreciation, this would signal a serious escalation in global trade tensions, as it would put pressure on other countries' currencies and trigger competitive devaluations. Once the devaluation pressure is released, it could also lead to increased volatility in financial markets. The weakening of the yuan against the dollar could also harm public confidence in China, negatively affecting consumer spending and causing stock prices to fall. This could also contradict the efforts recently made by policymakers to support the economy, as the collapse of the real estate market has already severely impacted China's economy, wiping out a significant portion of the wealth of the Chinese middle class. In today's closely interconnected global financial markets, exchange rate fluctuations remain a key concern for economists. From an international perspective, the US dollar's every move has a butterfly effect, deeply impacting the yuan's exchange rate. Global trade shifts also play a key role in determining the yuan's value. For instance, trade disputes or geopolitical conflicts can cause the market to lose confidence in yuan assets. If the trade environment worsens, investors looking to avoid risk often sell off emerging market currencies like the yuan and flock to the US dollar. As a result, the yuan's exchange rate could experience a significant drop. The movement of the offshore yuan against the dollar stirs concerns for countless individuals, both businesses and private citizens alike. Li, a business owner in Ningbo exporting electronic components, received an email from a German client on April 8th asking for an 8% price reduction. He shook his head with a bitter smile. He did the math. The price of plastic pellets imported from Malaysia had risen $1,200 per ton earlier this year to $1,320, and the yuan's depreciation has increased his procurement costs by 10%. Even worse, for export orders settled in euros, the 6% net profit was largely wiped out by a 4.2% depreciation in the euro to yuan exchange rate. Now his profit per order is less than 3%. Far away in Beijing, Ms. Zhao is experiencing the financial impact of exchange rate fluctuations. Her daughter's tuition at New York University for 2024 skyrocketed to $83,000 per year. When the exchange rate was 6.8 last July, she needed 564,000 yuan for the tuition. But now, with the exchange rate at 7.4, she needs 614,000 yuan. If the exchange rate reaches 8, she'll need 664,000 yuan, and an additional 100,000 yuan in expenses over the course of a year. Rent and living expenses have also gone up. Wang plans to travel to Japan with a budget of 10,000 yuan to exchange for yen. At an exchange rate of 6.8, he could get about 200,000 yen. But with the yuan at 7.4, he will only get about 185,000 yen, meaning his purchasing power has shrunk, potentially diminishing his travel experience. The most direct impact of the yuan's sharp depreciation is the rise in living costs and the decline in purchasing power, particularly for those reliant on imported goods, with overseas consumption needs or holding yuan assets. For example, products dependent on imports like baby formula, cosmetics, or electronics may become more expensive due to exchange rate fluctuations. For the general public, currency devaluation leads to the uncomfortable reality of money losing value.